After the stock market peaked in January 2022, it went on to fall around 27%. But since then, the stock market's been strengthening, seemingly ignoring any negative news on the global economy front. Trouble is, we now have multiple factors that could be signaling very sharp falls for the stock market ahead. And if the worst happens, we could end up seeing a massive stock market crash up to 50%. So is this latest stock market strength just a dead cat bounce? Just a small move in a much larger bear market? Just a small bit of strength before the inevitable crash? I'm Biko Konstantinos, and that's what we're going to talk about today. Did you know that the global stock market has a total market capitalization of $107 trillion? That's big. You know what else is big? My candelabra. But you want to know something that I wish was bigger? My subscriber numbers. So help out an Aussie with a like and subscribe. You won't regret it. The Standard & Poor's 500 gives us the best representation of the entire stock market. And from this chart, you can see that the US stock market has had an amazing run for more than a decade now. COVID hit in 2020, where we saw sharp panic selling followed by an equally sharp rise in what we would call a V-shaped recovery. And guess why this recovery was so sharp and led to a crazy boom? Money, baby, and lots of it. Stimulus on steroids. Paying businesses and staff while everyone's locked down. Buying up a stack of bonds, which is what we refer to as money printing, because the Federal Reserve just creates that money out of nowhere to buy the bonds. So all this money flowing into the economy created one of the sharpest booms in the stock market. And it also saw some of the wildest speculation ever seen in the financial markets. We saw crypto mania. We saw the Reddit GameStop phenomenon. The rise of NFTs. Remember the Bored Ape selling for hundreds and thousands of dollars? We saw one of the biggest housing bubbles in history as interest rates were reduced to zero and kept there for lengthy periods. So this entire boom period here is referred to by many as the everything bubble. Now, when you think about COVID and you think how we had the worst pandemic in our lifetime, with pretty much the entire globe locked down, unable to work, you would actually think that this would be terrible for economies and for the broader stock market. But because of all the money flowing into economies, we actually saw the opposite happen. But unfortunately for all the speculators, the party had to end. And from the start of 2022, we did see a significant decline in the stock market, with the low nearly falling back to pre-COVID levels. But it's the recent trading that's got everyone licking their lips. I know. I'm sexy. Investors are salivating at the prospect of another bull market. But is this wishful thinking considering the state of the global economy? Let's have a look. Firstly, corporate insiders have become very cautious. This ratio here in red depicts corporate insiders of a company, for example, members of the board or executives, and it shows us the value of stocks in the S&P that they have bought over the value that they have sold. Now, on average, they'd always be buying more than they would be selling, but when we see spikes in data, it can be very telling. For example, after the sell-off during COVID, look how insider buying surged. It surged above 3, which means during the lows of COVID, corporate insiders were buying 3 times more stock value than they were selling. And guess what? We also had a spike in October 22, which corresponded with the low in the stock market. So as we mentioned earlier, there's been an increase in the stock market over recent months, but just recently, insider buying has dropped below average, with average being this pink line here. So this gives us a clue that corporate insiders are getting a bit more cautious after the recent rally, which is worth paying attention to. Next, we have the inverted yield curve. An inverted yield curve occurs when short-term debt instruments carry higher yields than long-term debt instruments of the same credit risk profile. So we're basically talking shorter-term bonds are paying a higher yield than longer-term bonds of the same risk. Now, inverted yield curves are unusual because longer-term debt should carry greater risk, and as a result, higher interest rates. Inverted treasury yield curve is so closely monitored because it's the most reliable leading indicator of an impending recession. So to obtain the yield curve, a typical spread will be between 10-year treasury bonds and 2-year treasury bonds. And that's what we have here on this graph. So typically the spread might be between 1 or 2, which means that the 10-year treasury bond is paying 1 or 2% higher interest than the 2-year treasury bond. So here where the spread is 2%, the 10-year could be paying 6% and the 2-year could be paying 4%, showing that difference or spread of 2% as an example. Now every time this spread goes below 0, that's what's known as an inverted yield curve, which means that the 2-year treasury bond is actually paying a higher interest rate than the 10-year treasury bond. So how is an inverted yield curve normally formed? Well, as concerns of an impending recession increase, investors tend to buy longer term treasury bonds as a form of protection and a way to preserve capital. So that can lift the price of the long-term bonds, which has the effect of reducing the yield on those bonds. So over the past 50 years, every time this yield curve has been inverted, it's been followed by a recession, as indicated by this light grey fill. In the late 1980s, we saw an inverted yield curve followed by a recession. Then in 2001, where we saw the dot-com bubble crash. And more recently in 2006-2007, the yield curve inverted and was followed by the global financial crisis. The spread between long and short-term bonds right now is larger than it was prior to the last 3 major recessions. And because it's so reliably predicted historical recessions, I don't expect that to be any different today. The US stock market looks overvalued. According to estimate.com, the US stock market currently appears to be overvalued by 38%, meaning it would take a drop of 27% to bring the market back to the long run equilibrium level. Now, when we saw the peak in the everything bubble, the market was actually considered to be 81% overvalued. Now, this is all based on the Shiller's cyclical adjusted price to earnings ratio, known as the CAPE. Now, here we've got the equilibrium level, and all the times the market deviated and become extremely overvalued. So here in 2000, before the dot-com bust, we saw extreme deviation, and then late 2022, we also saw the same sort of extreme deviation. Since then, the deviation levels have come down, but are still showing as still significantly overvalued. And this chart clearly shows how the stock market became extremely overvalued post-COVID, where the flood of money sent speculation through the roof and basically artificially inflated all asset classes. So these overvaluation measures aren't a guarantee that stock markets will fall, but they are an important indicator to take close notice of. Next, we've got the impact of elevated inflation combined with interest rates that have been hiked aggressively over the past 12 months, with the US going from 0 interest rate after COVID all the way up to 5% official cash rate since around March 2022. Now, the effect of such quick interest rate hike on the broader economy could actually be devastated in the long run. Now, we're starting to see some massive effects from this interest rate tightening cycle, with one of the biggest effects being the collapse of multiple banks. So far, we've seen the collapse of Silicon Valley Bank, Silvergate, and Signature Bank. We've seen Credit Suisse having to get a lifeline bailout or takeover, and right now, First Republic Bank is on the verge of collapse as well. Now, without even looking into all the decisions that affected these banks, let's just look at some of their share prices. Starting with Silicon Valley Bank, we saw post-COVID how the share price surged along with all the money printing and stimulus into the markets. Now, interest rates started rising around here, and look what happened to the share price from there. And as interest rates kept rising, we saw a shock, some unwarranted optimism, and then a crash before the collapse. First Republic Bank, very similar story, with a rise in 2020 along with everything else. Interest rate rises really start surging, market cottons on, and First Republic looks to be the next bank to collapse. Now, we could see a number of other banks start to collapse over the coming months and years as elevated interest rates basically exploit any over leverage and liquidity issues that the bank may have. On top of that, consumers are withdrawing bank deposits at record levels. But apart from further bank collapses, higher interest rates and higher inflation levels inevitably mean that consumer spending could reduce significantly. So as people can't spend as much, businesses' profitability starts to decline. And when that happens, we start to see an increase of layoffs. So unemployment starts to rise, and that can make things even worse for the economy, as unemployment people have a lot less cash flow, so they're investing less into the economy, but it can also mean forced sales of property and things like that. And the trouble is, this time for central banks, they can't just cut interest rates to try and stimulate economy like they've done many times in the past. Because if they do, inflation could remain elevated, or what they call sticky, and if inflation persists at high levels, that could be even more devastating for an economy. So the inflation/interest rate factor could put major downward pressure on the stock market in the months and years ahead. Let's see what a couple of the bearish experts are saying regarding our current state of the stock market. Jeremy Grantham is warning about significant trouble ahead because he believes we've had what he calls an everything bubble. And that's why he thinks the current state is so dangerous, because we don't normally see a bubble across all different asset classes. For example, stocks, the housing market, bonds, and pretty much any other speculative type asset. Grantham believes that because we're in the third year of a US president's term, the market tends to stay strong until April, which is where we currently are. But from next month, he believes everything could change and we could be back to the meat grinder. In other words, the stock market could start selling down again. Grantham is pointing to the S&P falling to 3,000 in what seems to be his best case type scenario, and all the way down to 2,000 if everything goes to crap. Now, Grantham's prediction for the S&P looks like this. A fall down to this 3,000 level would take the S&P below the pre-COVID levels to around here. But a fall all the way down to 2,000, representing a 50% fall from current levels, is lower than the COVID low and would be absolutely devastating for the global economy. So how likely is Grantham's prediction to eventuate? Well, if I look to the longer term chart of the S&P 500 and draw a trend line from the low in 2009, you can see from that time the market grew quite consistently and on multiple occasions fell back to this trend line. We even see it here again and then here again prior to COVID, with COVID being the only time that the market dropped quite a long way below this trend line. So what this trend line shows us is that since the global financial crisis, the overall stock market was growing quite consistently. That is until COVID hit. So like we mentioned, ridiculous amounts of money was poured into the system and the market got overextended. So instead of a nice consistent growth, we saw ridiculous speculative growth. So like a rubber band, it's come back a bit, but I do feel it's quite likely that the S&P 500 will return back to this trend line, and that would take the S&P to the low 3,000s. So with all the economic pressures we've talked about in this video, I agree that the market will most likely see significant falls ahead, especially as company earnings start to really get squeezed. Now, if we go to one of the most famous bears, the Big Short Michael Burry, he's tweeted out some cryptic stuff lately. One tweet just said sell, and then another tweet seemed like an apology saying he was wrong to say sell. And we have this tweet here where he says, going back to the 1920s, there has been no buy the effing dip generation like you. Congratulations. Now for me, all of these tweets from Michael Burry have been extremely sarcastic. I don't believe in any way he's changed his bearish stance, and I get the feeling from this tweet here that he just thinks the entire market is totally irrational, basically ignoring anything negative happening with the economy, especially since we've seen some major banks collapse, yet the stock market totally ignores it and seems to keep strengthening. So is this just a remnant of the speculative everything bubble, where people just assume everything's going to start roaring back up again? Or is the market stronger than we think and could go from strength to strength? Well, one thing I've learnt in the markets is that anything can happen. But for me, there's a higher probability of further declines. And if we enter a global recession over the coming months and years, we could actually witness a global stock market crash. I'm Biko Konstantinos.